Hi, my name is Aman and I'm a chartered professional accountant practicing in the Metro Vancouver region of British Columbia, Canada. You see friends, in this video, I will discuss an interesting case law of Mr. Wall versus Canada. Mr. Wall was a licensed real estate agent in Vancouver. The tax disputes arose due to the real estate related activities of Mr. Wall, who purchased 3 houses from 2004 to 2010. He demolished them, constructed new ones, and then sold them. He assumed that each property qualified for principal residence exemption, and he did not report any gains resulting from the disposition of these 3 properties. He was reassessed under the Income Tax Act because, of course, the Canada Revenue Agency said that the gains realized on the disposition of these properties were on income account. He was assessed under the Excise Tax Act on the basis that the supplies of these properties were also taxable supplies. Of course, he was not happy once he received the notice of reassessment for unreported business income from the Canada Revenue Agency. So Mr. Wall appealed to the Tax Court of Canada. So now, when the case reached the court, the main issue at the Tax Court of Canada was whether the appellant sold the homes on account of income or on account of capital. A secondary issue was whether the minister properly assessed the gross negligence penalties pursuant to subsection 163 of the Income Tax Act. For more related to this, you can watch my video, which is listed on the top of the screen. So coming back to the case, Mr. Wall insisted that the 3 properties were a place to live for him as a principal residence, and he occupied each property for a period of time before selling it. He asserted that it was only the circumstances which forced him to sell these properties. Because he intended to live in the homes, he argued that he purchased each home on account of capital and that he qualified for the principal residence exemption. The court weighed in all the common testing factors such as the nature of the property sold, the length of the period of ownership, the frequency or number of similar transactions, work expended or in connection with the property, the circumstances that were responsible for the sale of the property, and last but not the least, what was the motive behind the sale. You see, the court clarified that the motive was the most important factor, but it must be evaluated in light of all the other factors as well. After examining the evidence from both Mr. Wall and the Canadian tax litigation lawyer representing the CRA, the tax court found Mr. Wall not to be a credible witness because simply he could not produce documentary evidence to support much of his position and was selective in remembering the details of the 3 properties. Mr. Wall appealed to the Federal Court of Appeal as well, and he alleged various errors. Unfortunately, the FCA also disagreed and dismissed his appeal. So friends, you see, it is very important to take professional guidance from a chartered professional accountant to avoid expensive tax mistakes. If you want to be notified about our new tax videos, please consider subscribing to our YouTube channel. Thanks for watching, and I'll see you in my next video. Until then, bye.